IT I've mentioned before, you've got to keep your records for 7 years. So in 5 years' time, Customs comes to visit you and they said, can you provide me with your records for April 15 now? Okay? And you are required to be able to provide them to them immediately. What we used to do in Australia as advisors was, I'm sorry, the IT guy's away this week, can you come back next week and we'll be able to get you some information then. So they'd go away and come back, all right? You won't have such an advantage here. Customs will be asking for your documents, your records immediately. And you need to be able to get back there and work out whether they are still available. I understand with some dockets, the paper and the print disappears, okay, after a year or two. So it might be advisable to photocopy those documents so that they're still there, because you pull it out and it's blank and you claimed an input tax credit on it, you've got no proof that you had an invoice at the start, so incorrect return. Okay, so just little things like that. Transitional issues. You should be wary of things that start before GST but finish after it. A general rule is that if you do that, everything that happens after GST is +6. All right, so have I got an agreement, contract with someone, and does it allow me to charge them GST afterwards? Because if not, it's in your price. All right, so transitional issues are one thing they also should look at. Okay, yes, we're running out of time, 6 months and counting, and we need to move on so you can get some questions in. Okay, this is what I'm going to talk about in Australia. Types of supply, pricing and compensation. Basically the same sort of things, we just call them different things. We call them GST free, we call it input tax, but it's the same end result, all right? So, and our systems are similar to any other country you want to name. So in Australia, things that are taxable: cars, commercial land and building, and new residential premises. All right? In Malaysia, new residential premises are exempt from GST. In Australia, they were taxable. We zero-rated basic food exports, like everybody does. Health and education, zero-rated in Australia. We exempted residential rented premises. And financial services, again, everybody does it. It's too hard to work out. Nobody has, so we did it. Out of scope, government regulatory charges. Okay, so in a lot of ways similar to the Malaysian model, but not identical. You can't bring your Australian GST IT system here and plug it in and hope that it'll do the job for Malaysia. Now, the ACCC. So they started monitoring on the 1st of July 1999 and monitored till 2002. They got over 50,000 complaints lodged with them regarding businesses being involved in what we called over there price exploitation, okay? 7,000 investigations, 21 million Australian dollars refunded to customers. So businesses who were found to have done the wrong thing had to pay the money back to their customers. All right? 11 people were prosecuted, and they loved, once again, putting it in the paper, we've prosecuted Jeff for doing this, or Jeff has agreed to change his ways and fix up what he's done and to pay back everybody he overcharged. All right? So these are some of the things they did there. Now, they did 300, these are all data out of the ACCC's reports that they did. 320,000 price comparisons over 10,000 outlets. All right? The average price change in Australia was an increase of 2.6%. There is usually, with GST, a one-off increase, depending on the country, how much it might have been. Now, one thing they did target was supermarkets. All right, to make sure that they were charging appropriately, because supermarkets in Australia and here will have a mixture of taxable at 6 and zero-rated at 0 supplies. So they've got to work out which ones are which, right, and charge accordingly. They cannot charge 6% on a zero-rated supply. These are some of the average increases in Australia that the ACCC reported after 2002. Now, books and newspapers. books and newspapers in Australia were not subject to sales tax. So zero sales tax, GST comes in plus 9.6%. Okay, so 10% rate in Australia, so virtually all the GST got passed on in the price because that's where their costs went up. Clothing was sales tax free, it went up a little bit. Flour was sales tax free, it went up a little bit. Eggs, sales tax free, dropped. Fresh fish, up a little bit, it was sales tax free. Chicken, sales tax free, up a little bit. Soft drinks, surprisingly, went down, but they were taxable for sales tax in Australia. So I don't know what happened with the soft drink companies. Maybe they were doing too well before with sales tax, so they dropped their price for GST. So these are all figures that the types of things that you should see your domestic trade ministry doing, producing, providing you with data on these types of things so that you know what to look for. Now, what did they do? They abolished some state taxes. They introduced a first homeowners scheme because sales tax on building materials was zero. So most homes had no tax on them prior to GST. They then new homes got GST. So they introduced a scheme to provide first homeowners with some money. They cut income tax rates. They increased payments to pensioners, so people who are retired. They paid them cash bonuses, all right? They increased family benefit payments. But they introduced a luxury car tax and they introduced a tax on wine because the sales tax rates on luxury cars, I think, were 46.5 and wine was 32.5. So a 10% GST would have actually dropped the prices on those goods. So they wanted some extra money. And one other thing that happened in Australia is that the income tax area of the Australian Taxation Office was very busy when GST registration came in because some people in Australia who had never paid income tax before had to register for GST. And as soon as they registered for GST, the information was passed to income tax. Have you got these people on your books? No. Right. We'll go and see them. All right. So the IRB will probably get busy over here. Now, these are just a couple of simple examples which I won't go through in any detail because there's too many numbers on them. But what it actually shows is that as you take sales tax off and put GST on, you can maintain the margins that you previously had. And it also shows in the next slide that if you do not decrease your price, you'll actually increase your margin. All right, so these are the types of things that the Ministry of Domestic Trade will be looking for. Okay, have you backed sales tax out of your price? Have you put GST on top of the price? And is your price now 100 or 106? Okay, so important to be doing these exercises, right? So, and the result changes if the margins change. Because I think from memory in this example here, the wholesale merchant actually made more money. If that shows up in your records, I'd suggest you might have some problems with the authorities. Righto. Mr. Mock was going to do this. It's a bit hard for me. These are all the troops at our place that are involved in the GST project. First page there's some of the local guys, including Mr. Mock there, looking very fine on the right-hand side. Then we have some ring-ins on this page, myself and another guy from Australia, Chris Jenkins, and also another colleague from Australia, Dennis Lynn, who visits occasionally. And Mr. Chan down the bottom is ex-Malaysian Customs from many years ago and actually went to Ottawa, I think in '84, to look at Canadian GST. So Royal Malaysian Customs have been looking at this particular issue for a long time. Okay, they should know a lot about the issue. Now, question time. Anybody got some questions? Please? Okay. How are we going to do this? Where's the...
I've got a question for you. What about goods that have been brought in before 1st of April 2015, sort of like during the transition period? And I understand that you cannot claim GST on goods that have been brought in previously.
Okay.
The input tax.
Yeah. the situation which occurs with stock on hand, all right? So you've either imported or bought locally stock which has sales tax in the price. The provision here is very similar to the provision in Australia, and what it basically says is that if you have paid sales tax on goods on hand as at 31st of March, which you're going to sell after the 1st of April, you can claim a credit for the sales tax. All right, now the document that you need is a document that shows the sales tax clearly, or otherwise you can't get the full credit. In addition, if you're going to claim a credit, if the credit is less than 10,000 ringgit, you have to get a certificate signed by a chartered accountant, I think, from memory. If it's over 10,000 ringgit, you have to get it audited, and an auditor to sign off on the stock take and the documents that you used to justify. If you get a refund, it will be paid to you in instalments over 2 years, or it'll be offset against any monies that you owe. So the situation of, yes, you'll get a credit for it, but it won't be returned to you immediately. But you certainly can claim it. Okay?
Gentleman here, second row.
Hello. I registered for GST, but my turnover is below 500,000. Can I claim refund for input tax?
Look, if you register for GST, right, and you're under 500,000, that's subject to customs discretion. They can say, okay, yeah, we think you're going to increase your business, so we're going to register. You can claim your input tax credits. You have a liability to charge on your output. So it's just the same as if you were above the threshold. Once registered, depending on your supplies that you make, you have an ability to claim the inputs, but must charge. So yes, not a problem.
Hello. My name is Kwan. I've got two questions. The first question is, if the tourist comes in and if they buy goods, I understand that they can claim a refund when they go out from the airport, right? What are the places they can buy where they can get a refund? Is it all places or only designated places?
There's a requirement that you register under the tourist refund scheme to be able to participate in that. So yes, you have to have special registration for that site, I think. Not necessarily the business. I think it actually is to be a special site. So if you've got 4 branches, for example, you might have to register 4 branches. But there is a provision there that allows you to sell to those tourists, and when they go to the airport or the seaport, they can claim back any GST that was paid on purchases which they take out of the country. Now, the only things I think that are excluded from that are cigarettes and alcohol. I don't think they're part of the tourist refund scheme from memory. But it's a similar scheme that operates worldwide, that one. Yep.
Okay. The second question is, it's a bit technical because I'm an accountant. Okay. Understand that for gifts more than $500 to a person, right, they will be subject to GST. What source document do we give to apply in this case? Do we give a debit note to the employee? That sounds ridiculous because you're not going to bill him. So how are you going to account for that in the accounts?
Okay. Very fortunately, we don't have the gift rule in Australia. I encountered it when I arrived in Malaysia. Yes, but you're correct. Where you provide a gift to anybody, an employee or a customer or supplier or whatever else, and the value of the gift exceeds 500 ringgit in a 12-month period, you're required to account for output tax. All right, so you don't, well, I wouldn't necessarily recommend handing a note to the customer that you're giving the gift to and asking him for the 6%, but that's your call. But yes, you're required to pay it. Now, the problem with the gift rule, they have one in Singapore too, is that it requires you to track who you're giving things to. That, I think, will be a very big ask. In Singapore, they removed the tracking. They said, if it's over 200 Sing dollars, we want GST, otherwise we don't want to know about it. Here, if it's over 500, they want to know about it, but you've got to be able to find who did I give things to. And did I give them 200, 200, and then 200? Because it's the third one that breaches the 500, not the first two. So it is a very difficult rule to practically administer, in my opinion. Okay?
What about the source document? How do you account for it in the accounts?
In your accounts, well, the only cost you have is a deemed supply for the GST. You've got an input tax credit, which you can claim as a purchase, but it isn't a sale. The only accounting entry you've got is 6% into your output tax account.
So it's credit output and debit P&L. Is that?
Yeah, the accountant's nodding. I'm an economist, actually, so yeah, that sounds good.